Today we're going to talk about a series of topics that are pretty general in nature. Parts 2, 3, and 4 of this webinar will get into much more detail. But today we're going to talk about statistically looking at Social Security and why it's important to women, particularly important to women. We're going to talk about why and how you establish a My Social Security account. Social Security Administration strongly advocates everybody participating in Social Security has a My SSA account, so we'll talk about that. We'll talk about how you actually qualify for benefits and when you should file for benefits. We'll talk about how the benefits are actually calculated. That's something that is universally misunderstood about how your benefit is actually calculated. We'll talk about what happens if you decide to draw benefits prior to your full retirement age and continue to work. That is kind of a stumbling block for a lot of people. And so we want to be sure everybody understands the implications of drawing benefits early but continuing to work, because there are financial implications to consider. And finally, we'll talk about cost of living adjustments, what they are and how they happen and how they impact your benefits. That's part 1 of this webinar. Part 2 is going to get into details of spousal benefits, this thing called the restricted application that you may have heard about. We'll talk about this concept of deemed filing, which is something that people kind of stumble into, but we'll clarify that for you. We'll talk about widow benefits and the effects of remarrying. We'll talk about divorced spouse benefits, and we'll close with common law and civil unions and Social Security. Again, these are detailed topics, and we'll be exploring them in pretty good detail. Part 3 then is going to talk about dependent benefits, children's benefits, dependent parents' benefits. Social Security disability insurance is a whole topic that confuses a lot of people and has a lot of rules and regulations, and we'll clarify all that too. And this thing called the family maximum, which may or may not have an effect on your total benefits, your total Social Security benefits. So that'll be a detailed discussion as well, and that'll be part 3. And the final part 4, we'll get into this thing called the Windfall elimination provision in a government pension offset, which is something that a lot of people are surprised by. You may have read or seen things, or you may even be affected yourself, but it's something that a lot of people are troubled by and don't really have a good understanding of what it is and how it works. So we'll clear all that up as well. And we'll talk about the taxation of Social Security benefits, which is something that unfortunately catches a lot of people by surprise when they retire and we're not aware that their Social Security benefits can actually be subject to federal income tax. That comes as a kind of a nasty surprise to a lot of people. So we'll clear that up as well. We'll talk about the lump sum death benefit that most people are aware of, at least generally speaking. And we talk a little bit about receiving benefits abroad if you're working or living outside of the U.S., how that impacts the flow of your benefit information. And finally, we'll talk about Medicare and specifically the hold harmless provision and this thing called IRMA, which is income-related. I'm going to ask Eileen.
Oh, no, don't.
Income-related.
Medicare adjustment.
Income-related monthly adjustment amount.
There we go.
Thank you, Sharon.
There we go.
Even though I deal with it, I just know it as IRMA.
Yeah. So that'll be explained in depth too in terms of how it impacts benefits. Okay, so let's get into part 1. I'm going to turn it over to Sharon and Eileen at this point to talk about statistics, basically statistics that are important for women that are participating in Social Security or aging into Social Security need to understand. So with that, I'll turn it over to the real experts.
In with Eileen.
Oh, okay. Well, people say why women should be interested in Social Security and what Social Security plays in their lives, the roles it plays in their retirement. And I ran across a very interesting quote. We women outlive men and possibly our retirement sources of, retirement income. But you cannot outlive Social Security benefits. You have them, you can live to 150 and you will still collect Social Security benefits. Your money might run out of any, your IRAs, your 401ks, but your Social Security benefits will not run out, and that's important. So as you can see, along with that, on the slide, you can look, 65% of all beneficiaries age 85 and older. I mean, we outlive men. It's a fact. And so another thing that's interesting is typically spend more time out of the workforce. And another interesting statistic I found out, since COVID-19 pandemic hit, 2.2 million women have left the workforce, and 500,000 alone in healthcare. And that is a heavily dominated female profession. So that's very interesting, and this is going to impact them down the road. And another thing is why women typically earn less than men. Women typically earn 80 cents for each dollar a man earns. So earning less money is going to mean less Social Security benefits down the road when you do retire.
Yeah, that'll become clearer when we discuss how benefits are actually calculated. Then you'll see the impact of how that affects your ultimate benefits.
And another statistic to throw out there, statistic. In 2017, 64% of the workforce, part-time workforce, were women. That means we have less career earnings and less savings because we're working part-time, either being taking care of children, taking care of, our parents, and just being, we're just working part-time. So can we go on the next one?
Okay.
And this will show you how the portion of women, among retired workers has quadrupled, as you can see. Chart really well explains everything.
Incidentally, I didn't say this earlier, but if any of you would like a copy of these slides, simply email us and we will send them to you. Didn't want to bother people with it unless they're really interested in seeing the physical slides. We'd be happy to send them to you.
All right. So as you can see from the slide and everything, we have increased our participation in retired workers, beneficiaries. So let me go more background. Okay. As some of the things we said earlier, our benefits are 25% lower than men. Social Security plays a big role in women's lives as we age, and we're over 65. And, like I said, it's nearly half, as you can see, the third point, nearly half the unmarried women, Social Security beneficiaries. Social Security represents 90% or more of their total income. That's important to realize this.
Yeah.
So I think a lot of people think, oh, no. So, and as you can see, never married, elderly have a higher rate of being in poverty compared to being the married.
Yeah.
So now Sharon, she knows these. She sleeps by these. She knows these top of her head. So
this is a list of some of the most common Social Security terms that you need to be aware of and understand. Credits, quarters, the average index monthly earnings, sometimes called AIM and sometimes called AMY, depending on which person's saying it. Your primary insurance amount, PIA, delayed retirement credits, DRC, cost of living adjustments, COLA, and your full retirement age, FRA. Social Security and ourselves at times will use the acronyms versus saying the entire word, so you really need to be aware of what they stand for.
Yeah, we're going to explore each of these terms in the next couple of slides and in the next 3 parts of this webinar series. And I forgot to mention, you should see a chat pod on the lower right-hand corner. If you have any specific questions, feel free to enter a question in the chat pod. We'll be keeping an eye on that. And I'll cover this at the very end too. But if you do want to contact us with any specific questions after the webinar, I'll give you our phone number and the email address to email questions. But we'll do that at the very end. So. Okay, moving right ahead.
So how do you qualify for benefits? Well, you have to have at least 40 credits, which basically works out to be 10 years of working history. Now, that is your just minimum. And we'll explain what that means a little later, next couple of slides, why 10 years is just the minimum. And your benefits are accumulated throughout the working years. That means you can work 10 years and that's it for the rest of your life until you claim, as long as you have that 10 years. Now the credits are 1,000, and for 2021, it's 1,470. And for a quarter, that's a quarter. Now,
you're talking about income, the $1,470
yeah,
income.
I'm sorry, your income, sorry. And then the yearly is 5,880, Sharon?
Yes, and there's 4 quarters in a year.
4 quarters a year.
You could actually earn that 5,880 in 1 quarter, and it will account for your full credits for the year. The only time you would not get credit for all 4 quarters if should a person die and not have worked all year. Then they will only get credit for the quarters they actually worked.
So
and
this is
puts some people off guard when they apply for survivor benefits with a younger person passing away, because they wonder why they didn't get all 4 credits for the year, and that's why.
This is important because if for people that work seasonal, there are people that work seasonal, and if they make their quarters during that season, and then they don't work the rest of the year, at least they have their credit for that.
Right.
So, and your benefits are based, as we said, on your earnings history. Now, as your higher lifetime earnings results in higher benefits, of course. So, and it's important to track that. I'm not saying the government makes mistakes. No one is saying that. However, it is important to verify that all earnings have been recorded and reported to Social Security. And you can do that by opening My Social Security account to do this. You should, even if you're not ready to collect Social Security, let's say even in 10 years, open one. It's good to keep track of your earnings are reported correctly. Sharon and I were talking recently. Now, they'll go back for how long if you have your W-2s, right?
If you have your W-2s, Social Security will correct your earnings record back to your first year of employment if you have the W-2s to prove that you have missing earnings. Now, self-employment is totally different. They go by your net income. But when someone is self-employed, it is very important you check that earnings statement every year to make sure that the proper amount is reported. Because when you're self-employed, Social Security will only go back 3 years. That's all they'll give you credit for. So if you work self-employed for 10 years and then look at your statement and go, wait a second, they didn't enter those 10 years, they're only going to give you credit for the most current 3, and you still have to submit those tax returns and your backup support to prove that that's the correct amount.
Yeah, the key point here is that this is information that is recorded by the IRS, and then report it to Social Security to update Social Security records. So there's a handoff there where things can happen.
And another thing to be aware of, if you do see you have years missing and you don't have those W-2s, well, you're going to think you're supposed to call the IRS. Actually, you get those old W-2s from Social Security. No charge. They go back to, I believe, 1978 they can go back to. But you have to contact Social Security, and there's only one office in the United States that handles it, and you have to write them. There is no phone number to call, and there's a special form you have to submit to them to get those. It's one of those things we became aware Social Security doesn't seem to tell you, but that's where they actually come from, Social Security.
Yeah.
Okay. So moving into talk a little bit about my Social Security account. Sharon, you handle this question day in and day out. So.
Well, the importance of having a My Social Security account is you get to watch your earnings be reported every year to make sure they're correct. You get to see an estimate on your benefits, because when you look at that, at your earnings statement and the amount of benefits they're showing you, you are looking at an estimate. And it allows you to see your record, get proof of benefits, replacement Social Security cards, update addresses, phone numbers, change your direct deposit, and all this without the hassle of having to contact Social Security. They're very secure, and they're just, in today's world, they're pretty much a nice necessity to have, to make sure you're going to get everything you're eligible for when you get ready to apply for Social Security.
And if you do have to contact the Social Security Administration, this is the first thing they'll tell you. You need to have an MySSA account. So you might just as well do it.
Yeah.
Okay.
Now, go ahead. Do you want me?
Well, full retirement age, we mentioned this early on, FRA, full retirement age. We're continually surprised at the number of people that aren't really sure what their full retirement age. The reflex was age 65. That was always the retirement age, and that's no longer the case. So
people still believe that. I mean, it's ingrained. As you can see, your retirement age is based on the year you were born, except those people born on January 1st. Those people are actually considered the previous year. So if you were born January 1st, 1959, you would use 1958 as your full retirement age. So that's a little quirk with the Social Security. It's always the day before they consider your birthday. So. Okay,
but again, it's just surprising the number of people that aren't aware of what the full retirement age is.
Well, I think it's because you qualify for Medicare at 65, and everyone thinks that's the retirement age as well. And then they get a little shocked when they find out it's not.
Yeah, and we do get a lot of questions about that. Okay, I'm now turned 65, so I'm eligible for Medicare. That means I have to sign up for Social Security. No, that's not the case.
Correct.
Right. So,
and it's very confusing for a lot of people because the problem is even though there's two different departments, or whatever you want to call it, programs, you sign up Medicare through Social Security. So that's what throws off a lot of people as well.
Yeah, but that does not mean that
a lot of people are applying for Medicare because they don't realize they actually need to apply through Social Security.
Correct. A lot of people, and they have to have an SSA account to do it, My Social Security account to do it. And that throws them as well.
They go online, create a My Social Security account to apply for Medicare.
Right.
Because you cannot apply online for any sort of benefit any longer without having a My Social Security account. They made that a permanent condition in 2018. No My Social Security account, you can't apply online. And right now, all the offices are closed. So without a My Social Security account, your only option is to apply over the phone. And then the only record you have of your application is to ask the Social Security office to mail you a copy.
Right. Okay. Let's talk about getting the actual benefits themselves. Sharon, why don't you talk about the implications of early retirement?
Well, as the retirement age has been rising each year, is having a larger effect on making that decision to take your benefits at 62, because as the retirement age goes up, the reduction for taking your benefits early is also going up. Like, for example, if you're turning 62 this year in 2021, you have a full retirement age of 66 and 10 months, and you would receive 29.17% less of your full retirement age benefit. And another effect it's also having is when you delay to age 70, your benefits increase by 2/3 of 1% each month, equivalent to 8% for each full year you delay beyond your full retirement age. But we'll also notice that the percentage your benefit increases from your full retirement age is also less.
I think we should also note that the earliest you can file is 62. And then
when you're 62, but only if you're born on the 1st or the 2nd.
Yes,
If you're born on the 3rd or later, you do not become eligible until you become 62 in 1 month, because they have this rule that says you have to be 62 all month to become eligible for benefits. So if you're born on the 1st, you're considered born the month before. If you're born on the 2nd, you're considered born on the 1st of the month. Now, the day of the month, except for the 1st of the month, only comes into play in the year you turn 62.
Right. And we should also note that if you decide to take your benefits early at 62 or 63, 64, before your full retirement age, that reduction is permanent. It does not increase when you reach your full retirement age. And we've had a lot of people ask, well, I hit my full retirement age, I didn't get an increase in my benefits. Well, you took it early and it's permanent. And I think a lot of people don't realize it is permanent.
Right.
The only way it's going to increase now is through COLA. Your COLA increase, yearly COLA increase. And so, and also,
another way, but that's another chapter.
Yeah, we're not going to go there yet. That's for next week's, how you can increase your benefit. Another thing is delayed retirement benefit. You only accrue that up to your 70th, correct? The month before your 70th?
The delayed retirement credits start accruing in the month you reach your full retirement age and end in the month before you turn 70. So it would make absolutely no sense to delay beyond age 70, because you'll just be losing benefits.
Yeah, we have had some situations where people have contacted us and said, well, I'm 72 and I'm going to stop working, and I would assume my benefit continued to grow till then. Fact of the matter is, no, their benefit did not continue to grow, and an even more distressing fact is they lost 2 years of benefits.
Well, sometimes
they were able to get 6 months back, but that was it. They lost.
Yeah.
But they still left a substantial amount of money on the table, by not applying by age 70. So
correct. Yeah, they did lose money.
Yeah. Okay, just the next couple of charts are just graphs to talk about examples of how early and deferred retirement actually impact your benefits. Sharon, you want to talk us through these charts quick?
Well, anytime you take your benefits at 62, you're going to take the maximum reduction. I mean, people that had a full retirement age of 66, they only took a 25% reduction when they took them at 62. And the purpose of these charts is to show you how your benefit grows as you delay. So if you were 66, say you're still delaying your benefits, you're going to receive 132% of your full retirement age benefit. And that means that your benefit from the time you turn 62 to the time you turn age 70 is 76% higher than at 62. And then again, by going on for someone that slide, can you turn the slide, please?
Sure.
Oh, sorry.
Okay.
I was dozing.
Last year for 2020, you turned 62, you had your retirement age increased to 66 and 8 months. Now you took a larger reduction if you took your benefits at 62. But due to the way benefits are calculated, if you delay to 70, you're still going to increase your retirement benefit a full 76%. And then again, this year for people turning 62 with full retirement age of 66 and 10 months. Next chart, please. You'll see once again, the reduction increases again for taking your benefit at 62. You also see a slightly smaller increase through your delayed retirement credits. But once again, your benefit between age 62 and 70 will be 76% higher, regardless of what your retirement age is.
Okay. Now let's get into the real, what I consider the real fun stuff. Figuring out exactly how your benefits calculated. I would venture to say there are no more than maybe 10% of the population of people aging into Social Security really understand. We get the rumors that, well, it's based on your last 10 years of work. It's based on your last 5 years of work, whatever.
And last three years seem to be the favorite. You make a lot of money the last 3 years you work, and you're going to get this real big Social Security benefit.
Yeah. Well, then they get the number from Social Security Administration, and they say, "Wait, how can it be that low?" So let's go through the process so you understand actually how your benefits calculated. And Sharon, this is your baby.
Oh, just because I've calculated them from scratch. Okay, your Social Security benefits are actually based on your highest 35 years of earnings from which you've had Social Security tax withheld. There are people that work in positions where they don't withhold Social Security tax, so naturally those years of earnings are not calculated into that benefit. And each year through age 60, your earnings are actually indexed for inflation. That means they're adjusted to reflect today's value. This does not show on your earnings statement. So people like to ask us, what will my benefit be if, say, I retire at 62? Well, once again, that earnings statement is an estimate, but when they adjust all those earnings, they usually go from age 22 through age 59. They will use prior years if you need them when you don't have 35 years. And these are...
Should we also tell them if you
National Average Wage Indexing Series, which is when they take all the W-2s for the year, and that total is how they calculate those indexings.
Should we also tell them that the 35 years, if you don't have 35 years of work history, they will put zeros.
Yes,
and that's what we were talking about, the 10 years for base minimum.
That's
Yes,
25
10
zeros.
years, but all 25 years that you didn't work are zeros, and that gets factored into the 35-year calculation.
Yeah, they take those highest 35 years, and like you said, if you don't have 35 years, they add zeros. If you only got 10 years, they're going to add 25 zeros, and then they're going to divide it by 420, the number of months in 35 years.
Yeah.
Yeah, and again, going back to our statistical comments from early on in this discussion, this is how being out of the workplace, for a protracted period of time affects a woman's benefits.
Yeah.
And another thing women are doing, I'm guilty of it myself, is we work for our husband.
Oh, yeah.
Yeah.
Well, we want to help out, so we don't take any pay. So all those years, we got zeros.
Yeah. Yeah, and again, the key point that was mentioned just a minute or so ago of people that are, let's say, workers that are not on a payroll and therefore don't pay Social Security tax. It comes as a surprise to them that their benefits so low. I had a question a couple of years ago from someone that was questioning on behalf of his cousin or something that didn't understand why he was not eligible for benefits. And I said, well, what kind of a career did he have? And he said, well, he worked on his own doing odd jobs and, it was just paid cash. And so none of that income was taxed. And so there was no record on which to base the average index monthly earnings. So that's, again, that's how the benefit is derived. So it's important to understand that.
Very important.
Okay, now the real math.
Oh, the favorite part.
Go ahead,
Primary
Sharon.
insurance amount.
Yes.
PIA. Now, the primary insurance amount is usually equal to your full retirement age. And each year, depending once again on wage indexing, Social Security creates Ben points. Now, they're tend to go up every year, which gives you a larger percentage of your benefit. But if you look at how the Ben points are calculated, it shows you how Social Security benefits are weighted to lower income earners. What this does is someone that's a low income earner is going to receive a larger portion of their AIM, their average index monthly earnings. They can get anywhere from 40 to 60%. As your income goes up, which means your AIM's gone up, you get a smaller portion of your average index monthly earnings back, to where you may only get a maximum of 25% in your Social Security benefit of what you normally earned each month.
This is this formula is basically an example of the progressive design of Social Security, and it's a way of saying that Social Security is actually means tested. And so a lot of people don't really understand that.
Yes. They don't realize that because
the interesting thing about it, the way it's calculated out, it's in a manner that if you take your benefits early, you're going to get smaller payments for a longer period of time. And if you take your benefits later, you're going to get larger payments for a shorter period of time. But if you live to your average life expectancy, you're going to receive the same total amount of benefits.
Yeah, if you live and die according to the actuarial charts, there's no difference it makes no difference when you retire.
No one knows when we're going to die.
Yeah. Yes.
It's true.
So again, that's the math behind how your benefits calculated. It can be confusing, but if you just take a look at it, it does kind of make sense.
Yeah.
So, okay, now this issue of this thing called the earnings test, which catches a lot of people by surprise, unpleasantly so. People that decide they're going to retire at age 52 or any age before their full retirement age, but continue to work.
Correct.
So,
From phone calls I deal with, I find this can confuse more people than a lot of other areas of Social Security, is the surprise about how this earnings test really works.
Yes, it is confusing.
Starting on that, Eileen?
Well, yes, it's very confusing. When you take if you file early, prior to your full retirement age, you can still work. And in 2021, you can make, as you can see, 18,960. Now, the government, any earnings over 18,960, your benefits will be reduced for $1 for each $2 over that amount. Let's say you make 19,000. So that year, so you're $40 over. So they're going to take $20 of it, right? Yeah. My math doing the head, calculator all these years. In the year, but it's different in the year you finally reach your full retirement age. The month before your birthday, the reduction is $1 for each $3. Earnings up to $50,520.
just in that year.
Just in that year alone, just that year. Now, the month you hit your birthday, your full retirement age, yeehaw, you can make millions and it won't affect you. So, once you hit your full retirement age, go for it. But prior to that, you have to be very aware of the earnings test. So now the thing is, once they withhold money, you do get it back down the road. And this is a part that throws off a lot of people. Should we mention the monthly limit, or should I go into the whole?
Well, I was going to say, now that sounds easy. No problem. You keep your income under that 18,960. Where the confusion comes in is there's also a monthly limit. Now, this monthly limit actually is created in a retiree's favor. When someone wants to retire mid-year and they're under their full retirement age, you've already made over the annual limit, you have the option to use the monthly limit in your first year of retirement. What the monthly limit is, naturally it's equivalent to, for this year, 1,580, because you simply divide the annual limit by 12. What this means is, say for example, you retire in May. You start your Social Security benefits in June. Well, all the money you receive in June, as long as it was earned May 31st or before, will not affect your June benefit. You're fine. So you could have made $1 million through May 31st and get a full benefit for June, which you will receive in July. Where the confusion comes in is someone retires, reduces their hours, starts their benefits. They get confused with that annual limit where everything you earn before you start your benefits doesn't count. But when you continue to work, if you use the annual limit, it does count. They will count all your earnings from January 1st through December 31st. You can use the monthly limit, but you would have to keep your gross income or net self-employment for each month under $1,580. If you go over that monthly limit by $1,
Mhm.
you will lose the whole payment for that month. If you stay under, you get to keep that month.
Yeah.
And that's where the real confusion comes in. But you don't have to use the monthly earnings. You can still use the annual if it would benefit you to let them withhold $1 for every $2 you went over. So it's really important when you're going to start your benefits and continue to work that you are well aware of how the earnings limit works, to make sure you don't find yourself getting this letter saying you owe us $14,000. You don't want to get stuck in that.
And let's say that you owe just $100, and your monthly check is $1,000. They're not going to give you a partial check. They're going to withhold that full $1,000 check. They
Yeah.
don't do partials.
Yes,
You will,
they are.
what?
Then when they get proof of your earnings,
Yeah.
they will refund the difference in the following year.
Yes.
So you
So
will be
they're-
waiting for that $900 overpayment.
Yes. So that is why it's important, and it's caught a lot of people, as Sharon has said, a lot of people are surprised. They either get a bill for outrageous amount of money, or they don't get a check for, a few months.
And you don't want to find yourself in a position where you lose your job to find out you got this big overpayment.
Yes.
They will allow repayment plans,
Mm,
but
Okay,
it's
well,
not a good position to be in.
no.
yeah, what you're seeing here is an example of a couple of the rules of the 2,708 separate rules that govern how you actually access your benefits. So
Yeah.
it can be very complicated, but again, that's why we're here.
Yes.
If you have concerns or questions, just contact us, and I'll talk about that in a second. But let's move on to COLA, cost of living adjustment.
Mm,
Eileen mentioned earlier that you need to keep in mind that your benefit, once you apply for it and start to receive it, it's fixed, it's permanent, and will only change in the event of COLA, which is the cost of living adjustment. So Sharon, you want to talk us through COLA, how that happens?
Well, this chart is, to give you an idea of how COLA fluctuates over the years. And this, once you start your Social Security benefits, this is all you have to depend on for an increase. And as you look over the years, you can really see we used to get some high inflation, which we really don't want to see anymore.
mhm.
But in the history of COLA, there's only been 3 times that there's been no cost of living adjustment, and that was 2010, 2011, and 2016. But just recently, in the last 10 years, it's been relatively small, even though it seems like all our prices went up. 2020, it was only 1.6%, and 2021, it's only 1.3%. The good thing about the cost of living is if it decreases to a negative, they're not going to reduce your benefit. You simply won't receive a cost of living increase.
Yes. That's one good thing.
Good.
So that's important to realize.
Yeah, they're not going to make your benefit smaller.
No.
Okay, types of benefits. Just a quick review of the various types of benefits, and we'll be talking more about these in the next 3 segments. So Sharon?
Yeah, I mean, there's
Oh,
a lot of options out there, for women and for men that are watching. Everything's available to both. I mean, you got your own retirement benefit based on your record, spousal benefits, divorced spouses that meet the requirements, widows, children's benefits, child and care benefit. We will explain in great detail because there's some good options there. Parental, which most people aren't available. We're going to introduce you to that. And then, of course, disability.
yeah. And like I said, we're going to be discussing all these in excruciating detail in the rest of the program. And it's just another quick chart, difficult to read, but again, it's a little bit of detail about the type of benefits. And again, I think we're at 11 o'clock now, so I think that you know, we'll be getting into these in detail in the next couple of sessions. So you know, we won't cover it right now. So that concludes part one of our program. And again, if you have any questions about the material we've covered this session and in the future sessions, simply give us a call or email us. The email address is shown here on the chart, ssadvisor@amacfoundation.org, or the telephone number is 888-750-2622. So those are the two ways to contact us, and you know, we would be happy to work through any questions you have and put all these rules into the context of your personal situation. Yes. That's what's important. You know, you can look at the rules, but you need to consider how they apply to you individually, and that can be you know, difficult to comprehend at times. So we'll see you again then next Wednesday, same time. And next weekend we'll cover, next Wednesday rather, we'll cover spousal benefits, the restricted application, which is something that people hear about, but you know, very few people really comprehend what it is, and it's going away anyway. And we'll talk about that, and this mystical deemed filing. Sharon deals with that day in and day out as well.
Yeah. And if you decide to call in, if you experience getting the voicemail because the lines are full, please leave a clear message with your name, phone number, and a brief message. And rest assured, one of the advisors will call you back.
Yep. Yeah. Yep, absolutely. We're very faithful about that. Yeah. And again, as I said earlier, if any of you would like a copy of these slides, simply email us, info@amacfoundation.org, and we'd be happy to send them to you. So with that, we will conclude. We will conclude
week when we get into the meat of Social Security.
Yeah. Yeah, it's gonna get detailed. This was kind of an overview this first time out, but it's gonna get detailed for the next 3 sessions, and that's why we broke it into 4 pieces, because it's just too much for anybody to absorb.
Well, spousal benefits, what? GPO?
It would have to be a
little
4 to 5 hour webinar.
Gosh, yes, it would have to be at least, and you would your eyes would glaze over.
Yeah. So with that, we'll say goodbye, and I will personally say thank you to Eileen and Sharon, and to all of you for participating and for listening to us. And we'll see you next Wednesday at 10 o'clock.
Yes.
Have a great week.
Yep. Have a good week. Thank you.
Thank you.
Goodbye.
Bye-bye.